Good afternoon, everybody, and welcome to the latest Urban Living News webinar. Today, we are going to meet the money. We are going to be talking to a group of investors and lenders across the living sector about the state of the market and how we think it might evolve. My name's George Sell. I'm editor of Urban Living News, and we are a multimedia platform for the hospitality and real estate sectors. Now, these Urban Living webinars have two sponsors, and we're just going to see a couple of very quick videos to find out a bit more about them. And the first of our sponsors today is Minute.
Dear hosts and property managers, hosting can be difficult. We get it. Watching out for parties, making sure your guests have a wonderful stay, keeping neighbors happy, coordinating cleaning and security staff. We see all the work you do every day, and we want to help. Wouldn't it be great to have a co-host? Someone to welcome your guests when they arrive. Remind them about house rules when they're getting a bit too loud. Keep your home safe when they leave. We're Minute, the co-host that helps you care for your home, guests, and community. We come highly recommended. We're reliable and we're eager to help. So let us be your co-host today. With love, Minute.
So thanks to Minute, and if you'd like to find out more about them, there will be some contact details posted in the chat. And our second sponsor today is Price Labs. So thanks to Price Labs, and again, you can see their contact details in the chat if you'd like to find out more. So today's webinar is going to last an hour. We'd like to make it as interactive as possible. So if you do have any questions, please do submit them using the chat or the Q&A function in Zoom. When we get to the very end of the session, we're going to leave the countdown clock open again for a couple of minutes because there's going to be quite a lot of information posted in the chat during the session. And everybody who has registered today will get a link to a recording of the session over the next couple of days. So just for some context, I just wanted to show you some screen grabs of stories that we've run on our websites in the last few months, just to give you an idea of the kind of asset classes we're going to be talking about and some of the deals that have been happening. So a couple that spring to mind here. A big American institutional investor forming a JV with a UK build-to-rent developer and operator. That's becoming more and more typical. The senior living sector is set to see around 3 billion of investment this year. We've got a refinancing story there. There's quite a bit of that going on. And also, we are seeing projects starting to be shelved because the cost of construction in some places has made them unviable. So one of the universities in Dublin, I think it was UCDA, was looking to build several thousand PBSA units, and it's put those plans on hold for now. And on the next slide, we have some other stories going on. JVs seem to be quite popular at the moment. So in America, there's one for the US single family rental market, JP Morgan and Haven. And institutional investment is starting to also come into the newer sectors such as co-living. So Cohabs, which is a Belgian company, has just secured 3 institutional investors to fund its growth. So let's move on and meet our panelists today. We've got a lot of knowledge and a lot of experience today. We were having a little bit of trouble getting hold of Simon, so I'm not sure if he's here yet. But in the meantime, I'll ask the other guys to introduce themselves in turn, and we'll go from left to right as we see you on the screen. So first of all, Nick, good afternoon to you.
Yeah, good afternoon, George. Good afternoon, everyone. My name is Nick Cussen. I'm head of business development for Kinetic Capital. We're a specialist lender focusing on student accommodation and, I guess, wider operational living sectors like multifamily and co-living.
Thanks, Nick. And Martin, welcome to you.
Thank you, George. Thank you, everybody, for having me here. My name is Martin Zdravkov. I'm a lead portfolio manager within the real estate business of DWS. DWS, for those of you that are not aware, is the asset management arm of Deutsche Bank.
Thank you, Martin. And good afternoon to you, Mark.
Good afternoon, George. Good afternoon, listeners. My name is Mark Quigley. I'm the managing director of a company called Beaufort Capital. We're based in Knightsbridge, and we provide property development finance to experienced developers, any real estate asset class, anywhere in Great Britain. And one of our main thrusts at the moment is looking at the likes of care homes, retirement living and student accommodation, but essentially, as I say, any real estate asset class anywhere in Great Britain. Thank you.
Thanks, Mark. I'm not sure if Simon is there yet. Simon, are you there? No, hopefully he'll be able to join us shortly. Okay, let's kick off the conversation in that case. Obviously, we find ourselves in fairly uncertain times at the moment. Geopolitical and socio-economic factors are changing the landscape quite rapidly. How has investor and lender sentiment towards the broader living sector been affected by recent events? Martin, would you like to kick off with that one?
Yeah, no, absolutely. I'm happy to kind of talk through our approach and to the current situation. So, again, we are a multi strategy firm, and my focus is specifically on the equity real estate investment across Europe in the living sectors. So it's fair to say that while the tide was very high for core living assets pre-summer of this year, that mood has changed very significantly in a kind of the post-summer. The desire of capital providers to get into core living real estate has completely gone out of the window. So the mood music has changed quite significantly in that sense. Then the flavor of the month at the moment is really more kind of the value add, opportunistic, kind of double-digit returns opportunities. While pre-summer, everybody was looking for stability of cash flows over an extended period of time. Now, in terms of what we are doing, we are continuing to focus on residential as a main subsector within the living. We're looking at student accommodation across Europe. We're looking at co-living. We want to do more in senior. It's a very fragmented space. Mm-hmm. Student is also a very fragmented space. We are fully aware and kind of like walking into a number of opportunities with our eyes wide open about regulation coming in the residential sector. If I were to be a betting person, I would say it's a matter of time before rent regulation sets in the UK. I don't necessarily think that regulation is a bad thing. It just depends on what you're regulating and how you're regulating it.
Yeah, okay. Don't you have to be a betting person to be an investor? Isn't that the name of the game?
It is the name of the game. Absolutely. I think it's so. Yeah. Okay. Fair challenge, George. Challenge accepted. I would say that we are probably within a 3-year period, we would see more regulation on the rent setting in the UK context. Yeah. Hopefully, that's going to follow patterns that we have seen across the continent, which are the initial letting is not regulated. So effectively, you let it a market. What happens is that once the tenant or once the consumer is in that property, you cannot raise rents by more than X. Yeah. And the ultimate question is, what is that X?
Yeah. Okay. Thanks, Martin. Mark, that's quite a significant change in attitude and scenario that Martin's talking about there. From a lender's perspective, are you seeing something similar?
We certainly are, but at the same time, I think we need to sort of take a step back before we move forward and understand what it is that we're currently seeing compared to what we've been used to seeing. For those less experienced or younger members of respective teams around the country, some of them will have only known in their working life what we're seeing and what we've seen over the last sort of 10, 12 years since, if you go back to the GFC. And of course, you know, for those of us who've been around a little bit longer, I mean, this is now my third recession, and I've seen so many things happen during that time. I was driving around the country the other day, I was listening to one of the radio shows, and somebody rang in and said when base rate was increased most recently to 3%, oh my goodness, you know, rates have never been higher. Well, I remember base rate being 15% in my working lifetime. But taking that at one level, what is it we're seeing day to day? I was speaking on a panel session the other day, and actually in person, and somebody asked me a question from the floor and said, Mark, you've been very positive about the sector, you know, the property sector forever. Surely even you must accept that there are challenges now and so on, and will you not therefore stop lending for the time being? And my response was, yes, I've seen lots of things, but my issue is this. When we at Beaufort make a decision about lending, we're trying to second guess what the world's going to look like in 2, 3, 4 years' time, not what it looks like today. And, you know, if I was going to take my foot off the pedal today, I potentially could lose a lot of good business. If I'd wanted to do that, the decision should have been taken 2, 3, 4 years ago. So if somebody comes to see me today and says, Mark, have I got a deal for you? I've got this plot of land, and I'd like you to help me finance it. And then they're going to work up their planning permission. They're going to tender a building contract, let a building contract, build out the development, whichever asset class that might be. That's all going to take 2, 3, 4 years to come through. Now, if we're still in the same situation as we are in the current climate, in 2, 3, 4 years' time, we will have some major problems. Our issue, however, is that a lot of the problems are understood now. Inflation, obviously, is rampant, but we're hoping is tailing off. What's going to happen to rates, for example, when the MPC next meets? It might be another, well, it might be a modest increase this month, 0.25%, maybe 0.5%. But again, the feeling is that it's not going to be up at the 5, 6, 7%, which some commentators were talking about not that long ago. But the challenges are still there. It's still difficult to get the right trades on site at the right prices. We've seen that the construction costs of materials has leveled off quite significantly. In some cases, is tapering down a bit as well. I think one of the big challenges that people seem to always foresee and feel that there's an answer to, and I don't really buy into this, is that land price will always be the determining factor. So that if construction costs are going up and finance costs are going up, don't worry, land costs will come down. But that doesn't really make sense to me, because unless the vendor is selling in a distressed situation, if he or she truly believes that the land is worth, say, £5 million, why would they then knock it out at 4 or 3 million just for a quick sale when there's no pressure on them to sell? Surely they'll wait 12, 18, 24 months. Prices will, get to a new norm and then sell at that level. So I'm not saying there won't be good opportunities, because there will be a number of distressed situations around and about, and for those that have got the wherewithal to pick them up, I think there will be some bargains to be had. But to think that suddenly land has changed to such a degree that we'll suddenly have all these appraisals looking that much more profitable and so on, I just don't buy into. No.
Okay, thanks, Mark. Nick, you mentioned earlier that you're focused predominantly on the PBSA market. We've been seeing a lot of stories in the press from around the world, actually, about the acute shortage of student accommodation. So how have recent developments affected you? Is PBSA slightly protected from some of these factors because demand is so high?
Well, we certainly hope so. I mean, that's definitely part of what we'd like to see going forward. I think in terms of your question about sort of investor and lender sentiment, it's definitely an interesting one, because the impact that we've seen around inflation and rising interest rates are certainly a factor, And I think to Mark's point, build costs have been something that we've seen huge inflation in a lot of instances. But I think that certainly in student accommodation, I think that build to rent probably follows along with it. They are sectors that are still very attractive to investors. I think people are very keen to be in that. You know, there is a housing shortage in the UK and in wider Europe. People need places to live, and when interest rates rise, it's going to be harder for people to get on the housing ladder, and so the opportunity for people who are providing very high quality rented accommodation, which is professional, and also removes some of the headaches around, you know, having to split bills between 6 people living in a house or something like that, are all going to be really attractive. I think the challenge that investors have is that actually, from a lender's perspective, the liquidity is starting to dry up a little bit in the market, and by that I mean that we are seeing some of the major lenders in the UK who are pausing for breath, sort of assessing their strategy, and so I think that's a potential challenge. The benefit that we have, so Kinetic Capital are a fairly young company. We formed 2 years ago, but we've managed to secure some, you know, capital from some US investment managers who we're working with as partners, and you know, we have liquidity for the sector and we want to be active in it. So it's not necessarily bad news for us, but I think that the challenge if you're a borrower at the moment, probably quite a few of your traditional funding streams will be drying up, and I think, Mark, I suspect you're seeing a similar thing. It's interesting you say sort of wider than Britain. So we work across Europe. We're working on transactions in Italy and Spain at the moment, as well as the UK side. The supply-demand fundamentals in some of those cities across Europe are even more profound than they are in the UK. So in Milan, for example, there's 1 student bed for every 22 students, and that's more like 1 to 3 in somewhere like Nottingham, where there is still appetite and there's, you know, people are still building products. So what we're seeing is major institutional investors that we're dealing with are very, very keen to exploit those shortages, and they are kind of geographically agnostic. So they will work in Milan, or they will work in Barcelona or Madrid, provided the opportunities there. So that's the sort of the sentiment that we're seeing amongst investors. They're not panicking. Some of them are sort of rethinking what is an appropriate return, but everybody that we talk to quite a lot of people, are still saying, look, we are out there looking for product, we're pushing ahead with our opportunities. So there isn't a massive slowdown so far from the client base that we've got.
Is that skew in supply and demand being exacerbated by landlords who might traditionally rent properties out to students, putting those into the kind of Airbnb short-term rental pool? Is that a significant factor?
I'm not sure that that's the case. I think, but I do think that, you know, we were looking at a scheme in Milan. We were out there 3 weeks ago, and there was a developer who'd finished their scheme a little bit later than expected. They released the beds for a January let-up, where there is no semester 2 market particularly. They released 350 beds and sold them in a week, and it was 15% above their business plan. And our question was, well, where are these people living at the moment? Because they're at university. What are they doing? And the answer was, well, they're in Airbnbs. They're lodging in people's homes, and the demand was, you know, was enormous. You know, they felt they could have sold that 2 or 3 times over if they needed to. But I don't know if the nature of housing is changing. I think that we live in an aspirational society where people want their children to do better than they did, and university is one of the ways that you can try to help that journey.
Yeah. Okay. Thanks, Nick. I'd just like to quickly get your thoughts on we're going to run through a list of asset classes, and if you can just kind of quickly give me your thoughts on each of them, you know, a couple of positives and a couple of negatives for each, and then we'll come around again and I'll ask you which is the most attractive to you if you had to pin your colours to the mast. Nick, I suspect I already know what you're going to say, but we'll get to that. So Martin, would you like to kick us off with the build to rent sector across Europe? What you think are its main strengths and weaknesses?
Yeah, no, happy to do so. So build to rent is quite attractive. I mean, back to what Nick was saying and what Mark was alluding to, like the cost of living crisis, rising interest rates, that doesn't change the fact that the build-to-rent sector effectively serves a great societal need for a broken housing market across Europe. Simple as that. So I think the supply-demand dynamics are incredibly compelling. Build costs are rising. There is no doubt about it. So the question is, can you kind of, to what extent you can recover those build costs? Overall, across Europe, again, and it's kind of very difficult to kind of go more specific unless you kind of go into specific countries. I mean, for example, like in the Nordics, you cannot raise rents. I mean, effectively, rents are being set in accordance with a local commune of residents. I mean, like Spain at the same time is kind of completely different, where you have like regulation in Barcelona, but not in Madrid. Very nuanced kind of situation all across Europe. Overall, positive on build to rent in terms of the living sectors, but probably not as positive as some of the others.
Yeah, okay. We'll come to some of the others in a minute. Mark, what's your take on build to rent?
I echo a lot of what Martin said there. I think in this country, bear in mind Beaufort's focus is very much on the mainland in Great Britain. It's taken a long time to really get traction, and now it has, and we're seeing some significant schemes in the major cities around in the UK in particular. I think one of the challenges, though, is the fact that people can just gloss over a building and put the BTR stamp on it. But we truly need to understand what it is that we're offering. What is the actual product offering to the tenants? And for me, it's all about the amenity space. And the amenity space is both within the building and immediately outside, and closeness to transport links and so on. And if we get that right, then I'm completely sold on it, because it just makes so much sense. It is I agree with Martin, a truly compelling story. However, and if I go back to my starting time in student accommodation, so a number of people listening in will know that my main career was at Barclays Bank. I was there 31 years, man and boy. And back in 99, 2000, I started doing student schemes for the first time. And there was this concept of build it and they will come. And that was a shock to nothing, because there was all that you had were crumbling estates built in the 60s and 70s, and no concept of purpose-built student accommodation. And you could literally build it anywhere, and anybody who could afford it would come and have this wonderful student accommodation experience with lots of other people, all going through the same thing at the same time. I don't see the same in build to rent at all. You must get that location. We talk in our sector about location. Even that's old hat. It has to be micro location. Does it truly make sense to build this building in this specific location? And if that ticks the box, then we're away to the races. But it's absolutely understanding that first and foremost. And we're seeing far more discerning people in every walk of life. But when it comes to your home and where you're living and resting your head at the end of each day, that is obviously so important. And people will vote with their feet. If it's not quite the right location, if it's not quite the right product, if it's not got quite the right amenities and so on, then it will struggle. But given a tick in each of those boxes, absolutely flies out the door.
Yeah, thanks, Mark. Nick, what's your sentiment towards build to rent? And maybe you could talk a bit about the kind of new single family suburban build to rent kind of subsector as well, because it strikes me that's where there's a lot of potential.
Yeah, so I think build to rent in general presents a phenomenal opportunity for all parties, really. I think investors see it as a place where it could be the next student accommodation where they can build large portfolios and dispose of them. And I think that's right to a certain extent. I think it will fill a very profound need in society, where people need somewhere to live and they need a safe and enjoyable place to be. I think I agree to some extent with what Mark said around the amenity space, but I think to go one step further than that, actually, if you look at people that have been providing operational living for a long time, and really the student accommodation sector is the one to look at. The big difference is in the operational performance and the management teams that work within those. So if you get the right people providing the right services and making it feel like a home rather than rather than a hotel room or a flat, that's going to have a massive difference. And I think that there's a lot to learn from that sector. So I do think build to rent presents a phenomenal opportunity for everybody, and it's one of the strengths. I don't think it'll ever be 75% of our business, but we have a mandate to lend into that space, and we're talking to some of the larger institutions about some programmatic work. I think the challenge to that market, and this is probably more apparent on the continent than it is in the mainland UK, is that the yields are so tight now. You're talking about in some major cities kind of pushing towards 3%. It's very hard to put very much leverage in there before you start to really stress in terms of interest cover, and that is something that I think investors are going to be thinking about, because actually if they're looking at their IRR, they need to put some leverage into these deals to be able to hit the sorts of numbers they want. And if they can't put in as much as they had in their business plan even 3 months ago, you think 6 months ago Euribor was 0, and there was a view it might go up to 0.25, and that's simply not the case anymore. So I think that presents a potential challenge for them as a sector. I think the single family strategies, again, it makes perfect sense to me that there's an opportunity to live somewhere which is well managed, well maintained, safe, and has other people that are in a similar in a similar time in their lives to you in that environment. I think it will all come down to how it's managed and how the operational side of those businesses function. So you need a real estate business to be able to build and deliver those products, but you need a management company who's going to be able to do that sympathetically and is going to be able to really care about the people in those environments as well.
Yeah, thanks, Nick. Martin, what's your take on the student sector?
I like it. In a couple of words, I like it. I think the student sector is actually offers quite a compelling. I mean, people understand what student accommodation is. I think unlike some of the other subsectors, people get it. Just about everybody has either lived in one or knows somebody, a close friend or relative who has lived in one. And I'm yet to hear a story of a vastly negative student accommodation experience over the last 20 years. Mm-hmm. As an investment asset class,
we went a bit further back than that.
Again, slightly biased here. Like I try to keep close to the ultimate consumer of the student accommodation experience, even though I'm way probably kind of closer to another sector of the senior living than actually to the student accommodation. But I really like the student accommodation. I think it's from a pan-European perspective. Again, it's super fragmented industry. It offers a lot of scale and a lot of opportunities to kind of build platforms either within countries or across countries. It has a compelling proposition for a highly amenitized offering, which is more targeted towards the international, like the fully transient end consumer. Or at the same time, there is a very compelling proposition for the more kind of local, kind of mid-tier universities in Italy, in Germany, in Netherlands. So overall, I like it a lot.
Good. Mark, how have things changed in that sector since you were working in it with Barclays, and what do you think about it at the moment?
Indeed, I mean, the last 20 years has been extraordinary in many ways, but if I just go back to the sort of schemes that we were financing back then, it was pretty much 6-bed clusters. That was it. All the main players, Unite, UPP, Opal, were doing the same sort of thing. And you would have 6 rooms off a corridor, shared kitchen, but everybody would have their own ensuite facilities. And that worked very well for a while. We then moved on from there. We got studios, and I then financed things like townhouses. We then have got to the stage where we've got studios and duplexes and goodness knows what, all manner of combinations. students. And indeed nowadays, some of these cluster flats, you'll have anything from 3 people sort of jointly living to 20 people and anything in between. So it has moved on quite markedly in that period of time. I also mentioned earlier about sort of just building it anywhere and they would come, but we've distilled that right down now. It either needs to be in the city centre or outside the front door or the back door of the university, or in a truly understood student location if it's going to succeed. So a number of things have changed. But I'm often asked, look, you know, you've been doing it for all these years, but surely it can't keep going. And if I look back at all of those incredible headwinds, each time it's such a resilient asset class, it's sort of dusted itself down and gone again. And the stats at the moment, we've got more 18-year-olds leaving school, year on year, every year for the next decade. That's what's happening in this country. We're also attracting students. A lot of people will know that we've had a good influx of students from China over the recent years. We're now seeing them more from India, from Nigeria, the States, Australia, and so on. And that is set to continue. Now, they may not be quite as affluent as all of the Chinese students, which seems to be the case, but there's still a whole swathe of people coming into this country, want to have a British education, want to go to one of the renowned British institutions and so on. So my take on it is that there's still, I can quite easily see another 10 years of growth without even thinking too hard. A lot of these estates that were built in the 60s and 70s absolutely need to be decommissioned and rebuilt. And the first and second generation stock that I funded in the early noughties and beyond will need replacing at some stage and so on. So I think there's going to be a very good growth in the short to medium term, and I suspect will see me well into retirement.
Excellent, thank you, Mark. Nick, I'm not going to ask you about PBSA because I think we know. I think we know your feelings on it, but I do want to ask you about co-living, which in some cases the 2 products are starting to look remarkably similar. Are you active in the co-living space, and what do you think of the pros and cons of that?
We are active in the co-living space. It's something that we like, but I think that to a point that was made earlier, the key really is about location there and micro-location indeed. You know, we in fact we're working on a scheme at the moment in Spain, which has a mix of co-living and student accommodation alongside. And whilst you probably wouldn't want to mix that to the extent that they would be in the same flat or along the same corridor, it makes sense because a lot of those you know, the setup for those are pretty similar. I think there's a market for it. I think that it's, you know, it's an opportunity similar to build to rent, but I think you need to really understand who your tenant's going to be, because, you know, I would have thought that building them in tertiary places in the UK or in Europe would be very, very difficult. So they need to be in major kind of capital cities or, you know, major urban conurbations. I think that's the crucial thing for co-living. But actually, the product that we've seen, some of the things that we've seen have been really fantastic and really attractive for the potential tenants, especially if you're potentially moving to a new city, if you're setting up somewhere and you don't know lots of people, or you're kind of new to an area. I think those sorts of things work really well. Or indeed, if you're a group who want to be nearby, but you don't want to be sharing, you know, you don't want to be sharing a kettle in the morning. I think they're, you know, I think it's a really good concept.
It's quite. I think it can be quite an interesting intermediate tenure between student housing and build to rent. You know, in terms of that.
I think the challenge, George, is probably, sound like a bank answer, but the challenge is probably around the cost line. So I think that the issue, the gap between co-living and build to rent is probably the number of times a room turns a year, and you know, the cost, you know, the cost of you know, making that room sort of feel brand new for the new person that walks in. You know, the operational cost is obviously, it's not as high as a hotel, but it's not going to be as low as a student accommodation or a build to rent room. And so I think that, yeah, the cost, the operational cost side of it, which is inevitably going to have an impact on the NOI and therefore the values, you know, that's the area that will bring in a lot of focus. Yeah.
Martin, what are your thoughts on co-living?
I think it's very interesting, and I very much echo some of the stuff that Nick is saying. From the perspective of a total occupancy cost, I think it makes a lot of sense for the younger demographic, and for that kind of like the young professionals. Again, echoing what Nick was saying in terms of location. I think it, from my perspective, co-living works well in urban settings in the major metropolitan areas. Now, it's not, as Mark was saying, in the kind of his olden days of PBSA, of kind of build and then they'll come. Co-living is, again, quoting Mark, is super micro location specific. So unless you know where you're doing it and why you're doing it there, kind of having a very clear vision of what your end consumer demographic will be. And then if you look at it from a total cost, effectively a single payment, and then you take that operational cost risk in terms of kind of like utility bills, internet. I mean, like anybody who's ever tried to set up a new BT landline in this country probably knows that this is kind of the pain of anybody's existence when the engineer is gonna come in 3 to 7 weeks. It's a freaking cable, for crying out loud. Like, why can't you just set up my internet? No, 3 to 7 weeks. Thank you very much. So the younger demographic is not willing to wait for that much time. So being able to have a complete plug and play living experience from that perspective, I like it. The fact that it's a very fragmented sector, again, I like it. What I don't like particularly about co-living, in order to kind of be a slightly more controversial here, is like, I don't know what it is. Is it 12 square meters? Is it 25 square meters? Is it 18? Is it pushing to 30? Is it just studio? Like, I don't know what it is. And the fact that there is no commonality about the understanding, like how easy it is for me, the main challenge of co-living is if my operator goes away, how easy it is for me to plug in another operator and operate that asset at the same level. And that, I think, effectively, that extra risk comes with an extra return. It should come with an extra return.
I guess the size of the units depends on the quality of the location. You know, if you might be prepared to live in a 15 square meter unit in a great location, whereas if you were a couple of miles away somewhere worse, you pay the same for 25 square meters. I guess, you know, it's a premium, I suppose.
But again, it kind of goes back to the point of kind of like, if the operator specializes in, let's say, 15 square meters units, can they operate efficiently 25 square meter units? And I think it's a bit like kind of like trying to, I guess, from a hotel's perspective, trying to put in kind of like a 5-star operator into a 3-star budget hotel. Can they do that?
Yeah. Mark, how about you? What are your thoughts on co-living? And I mean, Martin says he doesn't fully understand it, and it's clear the planners don't understand it, which is one of the challenges it faces. But what do you think of the pros and cons?
Well, I'd go a step further and say that the developers and operators, bizarrely, probably didn't understand their demographic when they first started building these things and operating them. And if I go back to the collective and what they did, for example, their first scheme, which probably wasn't in ultimately the ideal location, but it was new and it was well tenanted and so on. But where they missed out, I think they thought the demographic was going to be the 20-somethings and the 30-somethings. And whilst there was a lot of those sorts of tenants, they also had a considerable number of 50-somethings, which might surprise people. And it transpired, and this certainly isn't sexist, but it transpired they had an awful lot of divorced women in their 50s. And the story seemed to go that, you know, they obviously had their family, for whatever reason, the children had left home and the parents had split up. And a lot of sort of divorced women ended up in these sort of units. But why did they do that? Well, they were going straight into a setting where they would have neighbours next door, upstairs, downstairs, etc., where they would have people who were in a similar situation as it turned out, and they would form their little groups and so on. It was an extraordinary turn of events that as I say, the developers and operators hadn't anticipated, but it seemed to work very well. And where co-living, I think, does do well is having that sort of cross-generational mix and so on, and just, you know, across all walks of life as well, it would seem. My take on it is that, again, in the right locations, these things can do extremely well. Again, it's all about that operational experience. It's all about the amenities and so on. But I just think it's again, if I look at it from many different aspects, it makes perfect sense to me. I was speaking to Michaela Hancock of Greystar recently, and we were chatting about the ideal scenario for her business. And they start off, they do, for example, student accommodation is one of their big things. Then, of course, massive BTR and so on. And then at the end of the scale, they also do retirement living. And I said to her, wouldn't it make sense if you got hold of a tenant during their university years and then kept hold of that tenant forevermore? So they moved seamlessly from being a university student into their first job, into subsequent jobs, go through, perhaps get married, perhaps have children, etc., end up in a retirement home and potentially a care home. And she said, Mark, that is it. If we could do that and just people wanted to be Greystar tenants, and we can give them that whole life experience all the way through, no matter what their challenges and so on, wouldn't that be a wonderful thing? You make one sale when they're 18 years of age, and then, you know, at the other end of the spectrum, you're seeing them in their final resting place and so on. And I think there is something in that if you're giving people what they want, you know, the world has changed so significantly. I look at my 4 children. Will they ever own their own house? Will they ever go down that conventional route and so on? Or actually, as I'm seeing with lots of the things they do, if they want something, they go and get it. They're not sitting there thinking, I'm going to pay for it on the never, never or whatever. I will hire it for what I need now. You know, the Uber, the gym membership, whatever it might be, there and then, and picking up on one of Martin's points, just wanting it there right then when they want it and having it and being able to move on from there. So as a consequence, I can see this type of product being very well used in years to come. And rather than my generation, and indeed the generation after me, having a lot of money tied up in houses and so on, just never going down that route.
Yeah. Well, let's go to the other end of the spectrum and talk about senior living, and see what you guys think of that particular sector. Martin, do you want to kick off? What are your thoughts on retirement property?
Yeah, so it's the macro perspective is incredibly compelling. I mean, it doesn't need further explanation. Where probably Nick is gonna echo what I'm saying is that the operational complexities are infinite. In a sense that, and again, back to the point, I'm not quite sure what the senior really is. In a sense that, like, what is it? Is it a retirement village? Are we all kind of supposed to live around Alicante? Don't get me wrong, I would love if I get to that stage. Are we kind of living all in a care home? I mean, the rate at which people are aging is very different between 60 and 70, and between 70 and 80, between 80 and 90. So it's very difficult to kind of talk about retirement living as a broad term, because there are multiple different products in it. At what point of time do you actually introduce care? Is care mandatory? Is it not mandatory? Can you kind of have it on demand? Back to that whole point that with Mark we were just speaking now. Again, I love the macro perspective. The operational side is probably where you see a lot of dead bodies, in a sense. No pun intended, actually. I just realized that's probably exactly the wrong thing to say in a retirement living context. I apologize for that. But you would see a lot of kind of failing operators, let's put it this way.
Yeah, I think you want to stick to buying them and not operating them, Martin.
Exactly, absolutely. Love the macro story. Will probably be a later entrant to that market once you have an established platform.
Yeah. Okay. Thanks, Martin. Nick, how about you?
Yeah, I think a lot of what Martin said there, I certainly agree with. I think that, you know, with an aging population and people who have got a lot of money tied, you know, a generation who have a lot of money tied up in their homes, it makes an awful lot of sense if you want to downsize and they do it somewhere safely. And, you know, I looked after a couple of sort of large retirement living developers at my time with RBS and NatWest, and they always did really, really well. And I think actually the ability to build a product, sell it at a premium, charge a management fee on the way through, and then have some say in the sale price at the end is a pretty good business model. I think I think that's great. I think the growth of it has been phenomenal. Personally, a bit like you were saying, Martin, with co-living, I don't really understand it. Some personal insight. My parents are in their early 70s, so they would be slap bang in the middle of that. But if you're kind of a relatively fit and healthy 70, you probably don't want to be living in a place with a lot of other people that are of a similar age. So I think that's something. I don't know whether that will limit growth, because as I said, there is an aging population, and they are incredibly popular. A good friend of mine runs the retirement business for CBRE, and he is incredibly busy all the time. So clearly there is a market for it, and maybe I'm wrong about that, but I think when it becomes an operational base, I think that does become challenging, because it's going to have to be regulated. There's going to have to be a lot of other bits and pieces. I think a sale model, I get it. I think that the kind of rental base is more akin to care homes rather than retirement living, and that starts to become a bit muddier. You see people with businesses that are over leveraged and challenged, and also the kind of requirement for staff and the overall management costs are going to be really high. But I think it's seen phenomenal growth, hasn't it? And I think, as Martin said, the business model makes perfect sense. It's just that you need to keep selling the rooms, don't you?
Yeah. And finally, Mark, what's your take on later living?
A few things I'd say, if I may. First of all, I absolutely understand the comment Nick makes about downsizing, but I was at another event recently, which you also hosted, George, and it was talked about right sizing, which I think is quite an interesting nuance, and probably not an unfair one. And in terms of, as Martin was saying about sort of age and so on, these typically kick in at 55 plus and go all the way through to 80, 90 or whatever. And I've got to say, some of the lads in the office here were being a bit cheeky the other day when I hit 55 a couple of years ago and said, Mark, now when we're looking at these retirement schemes, you can opine from somebody with, who could be interested in taking one of these things. A bit naughty, but anyway. But my take on it is this. People seem to either be the sorts of people that would want to go into a retirement home or not, or senior living, it's probably better to say, than retirement. And different people, different things. Similarly, I can echo the fact my parents still live in their own property, and I don't think would ever go into a senior living thing. That said, my grandmother did, and she absolutely loved it. Now, she went in her late 80s, and she would be taking part, for example, on the bridge club on a Monday morning, the keep fit on a Tuesday afternoon, the sewing group on a Wednesday, or whatever. And it became this extraordinary place for her. I was looking at a couple of schemes a couple of years ago now, and this was up in North Norfolk. And I was encouraged when I went to see the prospective client to ask the existing residents what they thought, and he had it in mind to build another couple of schemes in the nearby towns and villages. And I happened across this couple, beaming smiles on their faces, and they said, Mr. Quigley, it's quite straightforward. We go away on 6 cruises a year. It's lock up and leave stuff. When we come back, the grass is perfectly manicured. Everything is done. There's a swimming pool here. There's 2 full-size snooker tables. We're just away from the coast is just around the corner. We've got a wonderful golf course, etc., etc. For them, it was just the perfect situation. And indeed, their family had to book time in their diaries to see them because they were always so busy with other things. So it very much is a horses for courses type approach. The other thing I'd say is that there are a tiny number in the overall scheme of things. If you think of this aging population, millions of us getting to the 55 each year, it seems, and away we go, there will be bucket loads of opportunity. But again, wondering and trying to second guess where people want to live. Not everybody wants to live on the coast, but lots of people in their latter years do like to do that. Having amenities nearby, again, makes perfect sense. The scheme in question, I was talking about North Norfolk, there was a doctor's surgery just at the end of the road, and there was, you know, the hospital not that far away and things like that. People really thinking about where they might build these types of assets. So I think there's plenty of opportunity. Again, if I go back to something I said right at the very beginning when you kindly asked us to introduce ourselves, the three places that we're looking at the moment, really forensically, student accommodation, care homes and retirement living. And that is because in each of those situations, the demographics are just so compelling. So that's what I'd say about that. I will just go back to the point about renting versus for sale. And just understanding for sale for the retirement sector, and making sure that you've got a product that will pretty much fly off the shelf, because the stats would indicate, you know, if my wife and I wanted to buy a property, we'd view it once, we may view it a second time, or we may not before we put in an offer. But in this particular sector, people are viewing it 6, 7, 8, 9 times. And latterly, they tell me that the real decision maker isn't great Aunt Mabel who's selling the property, it is the eldest daughter. And again, that was news to me, but that does seem to be the case. And of course, the children have got a great say in it, because it's their inheritance if you're selling your family home and moving in here and so on. So there's challenges there. The other thing is, from a product perspective, what is it you're selling and what is it people want? And again, I've seen some horror stories where people think everybody wants just a 1-bed unit. They don't have to pay too much for, no parking space because these old people won't need to drive and so on. Let's get real. Most of these people will still drive. If it's husband and wife, they will possibly both have cars. Even if they don't, the children coming to visit them will have cars. You need car parking. You certainly do at the moment. Obviously, the world's moving on, but you do need car parking for the present time. And having 1-bed property is just not where it's at. 2- and 3-bed units absolutely all day long. So again, understanding what it is you're selling, to whom you're selling it, and again, where it's located, all of vital importance. But as a sector, we're big fans of it, would like to do more.
Yeah, okay. I just want to ask you all in turn very quickly, just to say which of the asset classes we discussed you think is the most attractive of the lot to your business. So Mark, go on, you go first.
I'd say student accommodation.
Yeah. Nick?
Yes, student accommodation also. I think that's the number one space as well with Bron, and I think it's what we understand about.
Okay, and finally, Martin.
Feel compelled to be slightly controversial. I'm going to say co-living, despite the fact that I said I don't know what it is, but
you really are a betting man. Good stuff.
Yes.
Okay. Do you expect to see further interest rate rises over the next couple of years? And if this pattern does continue, what effect will that have on your investment and or lending activity in the living sector? Nick, do you want to kick off with that?
Oh, thank you for coming to me first on that one. So I think the challenge in the UK certainly is that you know, the Bank of England have quite a blunt tool in order to manage inflation, and interest rate rises are all they have. There's not a lot of other things that can be done, and so I think that you know, short of inflation coming back down to much more manageable levels, I think that interest rates probably will rise. I think that you know, if you look at long-term SONIA, it's you know, the markets are buying into rates which are peaking considerably higher than they are now. You know, it suggests that's going to be in the middle of next year. So it may be that there's a short, sharp shock coming, and things will start to ease off after that. I mean, up until 2008 or 2009, the 50-year average for the base rate in the UK was 5.2, I think. And you know, we've all lived in a place where we haven't had to really worry about interest rates for the last 10 or 12 years. Interestingly, what we're talking to potential borrowers at the moment who are in positions where, rather than, you know, everyone's talked about, if you're talking about interest rate hedging, people have talked about caps for the last however many years, and it's likely that there are quite a lot of people that work in the sector that have never had to think about swaps at all. But I mean, swaps have been part of the discussion that we've been having with borrowers recently. I haven't actually seen anyone do it yet. but it's definitely, you know, the case that actually if you're trying to buy a cap at a sensible strike rate, it's very, very expensive right now. And if you want to manage your risk, you need to be thinking about other things. So, you know, I think the fact that caps are expensive and the fact that people are talking about interest rate swaps does point to some higher rates in the future. Yes.
Nick, does that tally with your experience? Sorry, Mark, does that tally with what you're saying?
Yes, as I said earlier, and I think that we're going to see another rise probably in December when we next the MPC meets and so on. But I think, you know, looking at the broader question, you know, what does that mean to our clients and so on? And of course, finance costs are a key part of any development appraisal. But if they're contained within, say, sub 5%, at the moment they're potentially even sub 4% base rate, then obviously that will make life an awful lot better than it looked 6-7 weeks ago. At the same time, everybody in the property development world needs to look at every budget line when putting their appraisal together, building in obviously sufficient contingency to cover all the unknown and unforeseen circumstances. But having, say, lived through such a high base rate before, which was just arguably unsustainable, equally the 0.1% and the like was unsustainable. And it's just transpired that, you know, we've edged up quickly in a short period of time, which has obviously given a huge shock in the system. But the reality is that we're moving towards, and whilst I didn't know this, the stat that Nick just quoted, that makes far more sense to me, that 50-year base rate average. And as a consequence, I could see us going back to something not just dissimilar to that. Hopefully it won't get quite as high as that, but it is of that ilk. And it needs to be factored in, obviously, when looking at things. The difficulty is that increased finance costs with increased build costs and just getting hold of resources generally has been such a challenge. And it's just trying to do whatever you can to the things that are within your gift. Obviously, people haven't got any control over rates per se, other than using the likes of hedging. But again, that might be a short-term position ultimately. A lot of our developers, when they get involved in their buildings, it's sort of 18, 24 months. You know, trying to get the hedging right for that is challenging. So my view is that we take a view on what we've currently got. We look at the likely trajectory, but without getting too excitable about it. And I think those of us who have been in the sector for as long as some of us on the call have, and can understand that, you know, having been through, this is my third cycle of recession. Oh, sorry.
Sounded urgent. You still there, Mark?
Yeah, I think he's got an alarm going off in his office.
Oh, it's in the minute. Okay. Martin, would you like to tell us what you think continued rising interest rates will have on you? Because you obviously have a slightly different perspective from these guys who are lenders.
Yeah, I know. So I think interest rates are going to continue to rise. I think you'll probably see them peaking at some point of time, kind of around Q2, Q3 next year. And again, with the risk of being slightly more controversial, I think one of the things that we kind of keep forgetting is that the rate of change, just overall rate of change, is quite phenomenal at the moment. So if all of these kind of downward pressures on the economy from kind of the higher cost of living across Europe, and kind of like negative consumer sentiments do wash through, and then they will wash through. It's a matter of not whether, it's a matter of when. You could see a very quick kind of clamping down on interest rates. So my kind of, again, slightly controversial, is that yes, they will go up, and they'll go up from now, but they'll come down faster than we are actually expecting it. So the question is, for how long are they gonna stay at that elevated level, and what would that do to investment volumes? I think what we're looking at, and back to what Nick was saying earlier, I mean, like, we have seen deals at 3 net initial yield on the continent in terms of resi. It's been staggering, but then you think about the fact that a lot of it, effectively a lot of the capital was German capital, which had negative negative interest rates on a 10-year bonds, actually 3 net initial doesn't seem that crazy. But I think these days are now kind of gone. You just need to look at the German REITs and where they're trading. They're trading at around 40% discount to net asset value, to see that there is probably a lot of repricing coming through, or at least the expectation of repricing coming through. So I think you will have to have a 3 to 5 year view on any investment that you make in 2023 in order to kind of see through the noise.
Yeah, brilliant. Great stuff. Thank you, Martin, and thank you, Nick, and thank you, Mark. Hope you're okay. Hope that alarm wasn't signifying.
Well, it was just a test. I'd forgotten it was 3 o'clock today.
Distressing. No problem. We've run a couple of minutes over, so I just want to very quickly run a couple of slides before we close off the session. So our next webinar in this series is a week today, and it's all about Gen Z. What do they want from urban living? I'm really interested to find out, because they've got a very particular and different set of requirements, I think, from generations that have gone before them. If you'd like to join that webinar, there is a link to register in the chat. Just wanted to give you a quick heads up about an event that we are hosting in Lisbon in the new year called Recharge. It's a great interactive event which moves around different European cities every year. Very much looking forward to coming to Portugal in January. If you'd want to find out more about that and get some tickets, you can see some information in the chat. If you're interested in working with us here at IHM, whether it's getting involved with these webinars or our live events, please do drop my colleague Katie a line. You can see her contact details on the screen and also in the chat. And finally, just wanted to say thank you. Thanks to our fantastic panelists for their contributions today. Thank you to you all for watching. If you're on any of the social channels you can see there, give us a follow. Thanks to Minute and to Price Labs for sponsoring. And as I mentioned earlier, we're going to leave the countdown clock open for a couple of minutes so you can take some notes from all the stuff in the chat. And I hope to see you all on next week's webinar. Thanks very much, everybody. Take care. Bye-bye.